so that I've got this taped for us to review over and over again. So on this part, Alpesh Patel's special edition, what I want to talk about here in this recording are two things: the value growth filters and how I use them, and the stock ratings and why they save you immense amounts of time and why they work incredibly well at forecasting securities. What is it about them that works so well? Okay, that's what I want to talk about. So just a reminder, when you open the Alpesh Patel Special Edition, what you see on screen, you see the Alpesh table, and what we're going to talk about today is you see my ratings for every stock. So I'm going to talk about what is it, these value growth ratings, and how do I use them to find investment opportunities. The other thing I'm going to talk about today is the value growth, the value growth filter. Value growth filter, which I use for 12-month holdings. Why is it accurate? How do I use it? So there's two things we're going to talk about. In that, we are going to talk about the ratings and the value growth filter. In my first webinar that I did, which should be on the ShareScope website, I discussed an overview of all of these. Now I'm going to go into depth. And in my third one tomorrow, I'll talk about, again, different aspects. But on this, I want to teach you how it is that I look for securities to invest in, how I find them, using all of these factors. So let's kick off. Okay, I apologize, yes, that some people might be losing sound. I got a notice up just on my end of the screen that some of the sound is wavering a little bit. It should resume back to normal again now. It's just as I switched off some applications on my other screens in front of me. Sometimes the computer is trying to do too many things at once. So hopefully you're okay with sound back to normal again. So let's start off with the value growth filter and how it is that we use it. Okay. Now the fundamental principle I wanted to come up with was, what if instead of just looking for value stocks, did you hear companies talking about, fund managers talking about, oh, we've got a value fund, and others will talk about we've got a growth fund, and others will say we've got an income fund. I thought to myself, well, if value stocks are good and growth stocks are good and income stocks are good, what if I could find those which only sit in the middle, which are an intersection of all three types, which are essentially, therefore, VGI, value growth income. So they're the best of the best of the best. And I thought, well, why don't fund managers do that? Well, the reason fund managers don't do that is because they can sell you three products. They get three sets of fees if they say, oh, you should have a value portfolio at the moment, or now's the time to invest in value, now's the time to invest in income, now's the time to invest in growth. Well, let me explain to you why I think my methodology incorporated into the Alpesh Patel Special Edition is actually the very best way, and I'll show you the track record it's had, not historic back testing, but actually the performance ShareScope have been monitoring in real time. The performance which then Barclays stockbrokers asked me, can you provide for our clients, which I did. So you actually have real live tested results and the performance records going forward of that. So the first underlying principle was, surely the very best thing to do is have all three, value, growth, and income. How do I then find that? Well, valuation, you'll be familiar with, PE ratios, price earnings growth. So I thought, well, I've got to start there. Growth was going to be earnings, i.e. profits, and revenue growth. So is profits increasing? Are they getting growth in their profits? Are they getting growth in their revenue? And I wanted to look at income, which was dividend yields. In other words, for every £100 of stock I own, how much do I get paid in dividends? That's dividend yields. Now, this would then allow me to ensure I pick stocks which had the best of all three styles. Stocks which had the best of the theories that everybody has, that growth stocks are the best, or value stocks are the best, or income stocks are the best. Because if I pick a bit of all three, then surely I've got the best of all worlds. And that actually has been the secret behind the outperformance of this methodology using the Alpesh Patel Special Edition. And you're all familiar with ShareScope and the volumes of data it all has. But many of you will probably think, well, wait a minute, I don't see if the earnings is growing and the revenue is growing and what the dividend yield is. I want somebody to filter through it. And that's where the value growth filter came about. So what happened? Sorry, I accidentally made the screen go blank then. So what I looked for then was, well, obviously, qualitatively, in other words, in looking for quality, I was looking for the best value, income, and growth stocks. But I didn't just want to be qualitative. You'll often hear fund managers saying, oh, we go meet the companies and we get a feeling when we speak to the directors and so on and so forth. Well, wait a minute, that's just too reliant upon gut instinct. But we know it's all about quality. So how do you mix quality? How do you mix quality? Sorry, that sign keeps on coming up. How do you mix quality with the quantitative measures when you've got all this data on Alpesh Patel on ShareScope of pegs and price earnings ratios? So what I did was I determined the variable. How do you determine good valuation? How do you look at P ratios and PEG ratios and revenue growth and earnings growth and return on capital employed? Because ultimately you don't all want all that education for that. You want all of that done for you. So then I did that as the first thing. The second thing is I determined the range of values. So I worked out, for instance, I'll give you an example, with price earnings growth ratios, that between 0.2 to 0.8 would be good. Now you might say, well, wait a minute, Alpesh, that depends on the economic environment, depends on the sector. You're right. But I'm only looking for the best of the best of the best. So if I miss stocks which happened to then do really well, it doesn't matter. As long as my portfolio did incredibly well, what did it matter if there were loads that I missed? As long as the ones that that will be good for my portfolio. And then I had to weigh these criteria. I had to weigh all of these criteria. I've got a message saying that the sound has gone on and off a little bit. I apologize for that. It should be back to normal again. You should have sound again. So what I did is I measured the weightings. Now, how do I decide how I weigh price earnings growth? How important is price earnings growth? Sorry, Ian, that the sound's been very poor. I'm assuming it's just the broadband connections. Normally, it's incredibly good. As I say, I'm recording this anyway, and I'll make sure everybody gets the link for the recording. On which the sound should be perfect because it's been recorded at my end, not through the internet. But let me just plug on because it is going to be worth just listening to tonight as well as the recorded version. So then I had to decide, how do I weigh the importance of price earnings growth versus, say, dividend yields? How do you know which one's more important? Now, the advantage of writing 16 books on this and having 200 columns in the Financial Times is you've read every single piece of academic research since time began. You've read every single other book out there. So I got a pretty good idea. How to weigh criteria and evaluate each and every single one. Now, I won't go into a 300-page book on how you exactly do that, but I came to certain weightings, certain criteria which I knew would work, and then weighed them. And that's what I did with the Alpesh Patel Special Interest. So in applying all the data and all the stocks we have on ShareScope, what I did is I put those stocks through the screen, and I'll come to risk and money management in a second. I might only look at, say, 600 stocks, so that would be essentially the FTSE 350 plus small caps. But if you wanted, there's nothing stopping, and I'll show you in a minute how to filter using not just the FTSE 350 plus small caps, but also adding in FTSE fledgling and AIM stocks. And then I'm looking for a portfolio of about 14 positions. So you might say, okay, well, Alpesh, you're going to have to explain a lot there. Explain to us what you mean by risk management, what you mean by money management, and why 14 positions, and how good are all of these quantitative and qualitative criteria which give you income value growth stocks. So let me show you. First of all, what that gave me was low transaction costs. Our strategy is to hold for 12 months. It's inherently not a high turnover strategy, so it reduces portfolio churn and transaction costs. Fantastic. Our profits don't get eaten away by transaction costs, a major problem with funds. Money management rule, it's simply this. 25% per position hard stop loss. That means any individual stock drops 25% and you go into cash in that position. Now, if you do your maths, if you've got 14 positions and any one of them can only drop 25% max, that means any one of them can only impact your overall portfolio by about 1.8%. So the maximum loss from any one position dropping 25% is 1.8% on your overall portfolio. Why? Because you've got 14 positions, each equally divided. I don't go overweight on one and underweight on another. And the reason for that is it's bogus what fund managers tell you when they say, oh, we're overweight in this and we're underweight in this. It's probably one of the most appalling ways in which to pick stocks. And the reason is this: if you're good, if you think your methodology is good, then you don't need to be underweighting any individual stock. I'll explain why as we go forward. Because you should be, each one of those should be the best of the best of the best. What you're actually saying when you start under and overweighting is actually I've got a lot of stocks and some of them aren't as good as others. The only time you do that is when you're a big fund manager with billions under management that you can't put small amounts of money. You can't put your money into the FTSE 250 or the fledgling stocks because you'll end up owning half the company if you do. And I wrote about this in the Financial Times. That's why a lot of the big funds, they do all the marketing, they get your money, but then they've got so much money off which they earn fees that they end up tracking an index because they end up owning the whole index because they've got so much money. We don't need to do that. That's why we can outperform big fund managers because we don't have 200 million to deploy. That being the case, we can equally buy all 14 of the best of the best of the best. And if any one of those in that holding, and that's why we only lose 1.8% because 1/14 times 25% is about 1.8%. Yeah? So your stop loss on any one is 1.8%. The risk impact of our 14% is the same impact on your portfolio. Same as a 200 million equity portfolio fund, because guess what an equity portfolio fund with 200 million pounds in it does? A fund manager from Fidelity or whatever, they will say their largest holding only has a risk impact of 1.8%. They're trying to replicate what we're doing, but they're doing it by taking all your 200 million in cash and still trying to do it. Well, no, they can't. It impedes them. We are using the advantage of having less money. Initially, value, growth, income. I'm only looking at the best of the best there. Then I'm filtering it even more, so I've only got 14 positions. A big fund can't do that. A big fund cannot do that for the very simple reason they've got too much money to deploy. And they're not going to say, oh, we're only going to have less money, because they've got big fat fees they can collect. Here, you're your own broker. All you're paying for is the cost of Alpesh Patel. You're not paying for anything else. You're not paying management fees, you're not paying annual admin fees and performance fees and all that nonsense, because you're going to do this yourself. I'm going to show you even more about how to construct portfolios well, better than a professional, never mind like a professional, better than a professional. So, we're going to have low transaction costs, we're going to have the best of the best there. Let's look a bit more into how this happens. Remember I called it value, growth, income. That's our USP. VGI is our USP. Sorry for all the acronyms. Unique selling proposition. Let me explain why. And this is going to teach you a lot about why we're better than the industry, and you can be better than the industry. Through this webinar alone, you are going to be better than the industry. Now, I run an FSA-regulated asset management company, so I'm telling you as an insider why you're going to be better than the industry. The downside of traditional styles of fund management when you pick value stocks is this. Value stocks can remain undervalued for long periods. We all know that. They can be excessively undervalued because the business is not viable. So a stock can be undervalued forever. How do we avoid that problem? How do we also avoid the problem that something might be undervalued just because it's rubbish? It might have a really low P/E ratio or price earnings growth because it's just rubbish and nobody thinks it's going to survive. How does our system of value, growth, income avoid that? As our stocks are also growth stocks, they tend to be spotted earlier by big funds because ours aren't going to be undervalued because they're rubbish, because they're growth stocks by definition. We avoid extremely strong value stocks or strongly growing or strongly yielding stocks, as these too can be problematic. See, something which is extremely well valued is problematic because it might not be strongly growing. So we make sure it's also strongly growing. That's how we avoid the traditional problem that value stocks have. The second way we avoid the problems that the big funds have. So, you'll get lots of funds saying, oh, this is an income fund, but you're always thinking to yourself, yeah, but it's going to be rubbish because I'm going to get next to no growth. Well, the great thing about income stocks, the problem with income stocks is yields alone do not ensure shareholder returns because you might get 3%, 4%. Well, great. What we do with our value growth income methodology, which you have on the Alpesh Patel Special Edition, I'm going to show you how you find those stocks in a second at the click of a button, because all of this value filtering, income growth filtering is all embedded into the software, is that yields for us provide downside protection. They're not there to give us a return. We're looking at stocks which have yields because if the stock price falls, then the dividend yields increase, because the way dividend yields are worked out is it's the amount of dividend you're getting per cost of buying the share. And if the share price falls, then obviously the return you're getting on the dividend per pound you spend on buying the stock, the yield has increased. So that ensures a floor to the price, because if suddenly a stock halves in price and it was yielding £3, it's now going to yield, 3%, it's now going to yield 6%. So it's not going to fall much further because 6% means a lot of people are going to start buying it. Alongside the real stocks we picked and the profits we generated, and ShareScope evaluated this independently, and so did Barclays. But growth and valuation criteria mean that the company should get selected and rapidly rise again. So if it falls, its yields improve, so we can't fall too far. But because it's a high growth company with good valuation, it should start rising. And I'll show you again why we therefore don't have the problem of income stocks or income funds, which is the typical problem with income funds being that they don't give you a return. Well, we've avoided that. What about growth stocks alone? Sometimes people invest in growth funds because they want a bit of testosterone to their funds. Well, these can be overvalued and not exceed expectations, causing price declines. It's a growth stock today. Tomorrow morning you wake up and its price keeps on declining. So why will that not happen to us? The overvalued growth stock, in other words. Well, because our stocks are going to be undervalued growth stocks. We're going to get growth in earnings and revenue growth, but they're going to have low price earnings and low price earnings growth. So that means we should get upward price rises and not price falls. But there's another very, very, very clever technique that I've used, if I say so myself, which I really want you to, be aware of in what I've done in creating all of this, and it's the exits. See, the exits I have are based on with traditional funds. They're based on the entry criteria. So if they got in on a stock which was because they're a value stock, a stock which is undervalued, they've obviously got to exit when that stock is well valued because they're a value fund. So they can't hold overvalued stocks. Or if they're a growth company, they can no longer hold a stock which no longer is generating growth, even if its share price, because it's undervalued, is still rising. We avoid that problem because our exit criteria are not based on our entry criteria. This is where it's really clever. We don't want to exit when stocks are, say, fully valued. We want them to be stonkingly overvalued when we exit. Of course we do. We want them to have lots of momentum when we exit. So our exits are based not on our entry criteria, but on time criteria, the optimal time. Without backtesting, without saying, oh, the optimal time is 11 months and 3 days, because I looked at all the data over the last 100 years. No, we based it on an almost arbitrary time frame, but it's arbitrary, which means it's not overly curve fitted. I picked 12 months, and the reason for that is anything shorter than 12 months, and valuation can't really reflect itself in the security, in the stock, and anything longer than that, and of course new data's come along, and we've got to revalue, re-go through our filter. So it became a really clever thing to do, is to pick 12 months. The proof's in the pudding, of course, so I've got to show you the proof. But there's several other ways. Let me just give you 3 more ways in which we're really clever with our value growth income, our VGI filter on Alpesh Patel Special Edition. First of all, I told you the transaction costs. We don't need 100 holdings because we've got 200 million under management like a traditional fund. We only have 14. So we don't have lots of trading commissions and churn because we're going to hold them for 12 months. Great. We're going to hold them because that's built into our system. You're never going to get a fund manager who says, I'm going to hold all my stocks for 12 months because his boss is going to turn around and say, Sunshine, I'm not paying you for doing nothing. Well, we want that because it takes time for the best companies to go up. And the way that the value growth filter runs is you can run it every day and you hold from that day for 12 months. So obviously in 6 months' time, the stock's valuations, everything will have changed, but that's from 6 months from now you run it and that's for the next 12 months. Or tomorrow you're going to look at it because you're going to create your filter and it's going to have different values to today, or it should pretty much be the same, of course, because in one day not much changes, but in 3 months it does. But of course that's for a 12-month holding from then. The criteria are always the same, but the daily data changes because what's going to happen in 2 months is Vodafone's going to have new earnings and that may no longer fit in for the next 12 months. But it does from 12 months for today, let's say. So let me show you this in a second. I'll show you this in a second, all of this. So we don't have the problem with transaction costs, which eat away our performance because we're going to hold them for 12 months. And why 12 months? Because stocks take 12 months in which to come to full fruition when they're undervalued and so on. We don't have the problem with what's called style drift, which is where fund managers say they're valuation companies, but actually because they're performing quite poorly, they move from being valuation based to being momentum based or being growth and so on. Well, we've already got that in there. You don't have the problem of, oh, I bought one thing but got another. So it avoids the industry problem there. But also the traditional problem is people have poor performance in bear markets. Guess what? Our stocks represent flight to quality stocks in bear markets, and I'll show you how in a second. Ours are the ones which are already undervalued, showing good growth and good dividend yields. Well, in a bear market, you fly to quality. In other words, those stocks producing good growth, good earnings, and which are undervalued. The problem with traditional funds is because they've got 100 holdings, how can they fly to quality? Because they've got everything in there. We are going to stick to about 14, 15 stocks, and I'll show you why in a second. So here's an example. Here's one from when we first launched the product. This is what happens, one of the original picks, and I'll give you ones from the last 12 months in a second. So this is how it works for 12 months. Now, DTZ after this may well crash and burn. We don't care. Once we've sold it, this is going from January to December. Once we've sold it, we don't care what happens, but it was a 12-month holding. And the way it happens is price drops are limited because price yields prevent the price dropping too far, remember, because valuations rise as well. So that gives us a protective floor to how far any of our stocks could ever fall. How clever is that? But that's not good enough. Because what we want is prices to rise. How do we get that? Well, we've got the growth filter in there. Growth results beat expectations, bringing undervalued stocks to market attention in months, not years, and with room for price rises due to the low valuation. You see, what a lot of other funds have is the problem that their stocks are undervalued and remain so for ages. Well, I already discussed that. Or it takes years for them to come to fruition, or the market never spots them. The reason the market's going to spot ours is because they're growth related as well as being undervalued. They've got a bit of everything, which is why they work and why because I need the market to find them. There's no point being the only genius in the room if the rest of the market doesn't follow me. So I need the market to follow them, and as in this case, give me 100% plus return in a year. So this is one of the original ones, and ShareScope can verify this independently because we picked it and then we saw how it did. This is Easyjet, one of the more recent ones. Okay, same. They'll all have the same format. They should go like that, like a hockey stick. Same principle. Can't drop too much. Then the growth results. By the way, value growth rating. There it is. 9 on this one. So the rating should correlate pretty much with the filter, but I'll go into that in a second in more detail. Another one from the recent past. Aberdeen Asset Management. Okay, same principle. Price drops are limited because yields and valuations rise, providing a protective floor to falls, and the growth results beat expectations. So I'll give you the names in a second of what's on at the moment. But you can do that. You've all got the Alpesh Patel Special Edition. You just click on the value growth filter. Now, I'll tell you how I use it in a moment, because there's more to it than that. So this was the very first batch we picked in 2004 when we launched the software, and these were done for Barclays stockbrokers. Okay, it was done for their clients, so, you know, neck on the block time for me back in 2004 when we launched this. This was their performance for that year in 2004. I might say, well, Alpesh, that was a really good year, 2004, for everyone. Well, no, because the FTSE All-Share was only up 8%. And I say All-Share because these aren't just FTSE 100, these are FTSE 350 plus small caps, which I really like looking at the filters on. So 34% when the rest of the market goes out. How's it done since? Actually, it's been outperforming the market every single year pretty much, and ShareScope have some of the results. This is how it looked for that first year when we launched. Okay, this is our performance. That's how we did. Okay, biggest drop, 8%. That's what you want. A good fund manager should be well enough diversified that when the market drops, it doesn't drop as much, but it just consistently keeps rising. And that was how we performed at that time. So why did I then say that I only want about 14, 15 stocks? Well, as this screen shows, as you go beyond that, the benefit to the volatility of your portfolio of adding more, the risk that's reduced by adding more, doesn't actually help. It doesn't actually help reduce the risk. That's why we only want 14 to 15. And also, if you've got the best of the best of the best, why do you need 100 stocks? If you're any good, why do you need 100? Because remember, if you're picking good stocks and you've got 100 stocks, then any one of them can only have 1% in your portfolio. If it's only got 1% in your portfolio, and let's say it's certain value, you've only added 1% to your portfolio value. We want to add more to our portfolio value. That's why we want 14 to 15. We want to balance the fact that they're so good that when a particular stock goes up, it adds a big impact to our portfolio. But we don't just want to invest in one stock because we're not diversified enough. Too much volatility and risk. What's the right balance? What's the right balance? About 14 to 15. Guess what? A fund can never, ever, ever, ever do that. It can't do it because the FSA won't let it do it. They'll say it's too concentrated, even though that's what's best for you. It won't do it. Not just because of that, it won't do it, because if they've got 200 million of your money, then what's going to happen is they can't just put it in 15 stocks because they'll end up owning the whole company. And they're never going to say to you, oh, we want less money, because they've got fat fees to earn. That's why we want to do it ourselves. So we pick the best using value growth income. I want you to be able to do it. And that's what ShareScope Alpesh Patel Special Edition allows us. So what's the strategy with it? Stock selection based on value growth and income. Remember, it's in the filter. Individual stop loss of 25% on any one stock. If it drops 25%, like we had in the crash of 2007, you get out. Target means that the largest position would ever only be 7 to 8% of your portfolio, because you're going to have 14 stocks. 14 stocks, each having 8% of your portfolio, gets you to about 100%. So isn't that great? Any one stock is only 7 to 8% of your portfolio. Because it's only 7 to 8% of your portfolio and the most it can drop is 25%, the risk to your portfolio is only 1.8% of any one stock. And the beauty of that is that's the same as what the biggest fund managers have on their overall portfolio. Diversification through a number of holdings, diversification through sectoral spread. Now you might say, wait a minute, Alpesh, you're picking these bottom up. What if they all turn up in telcos? Well, they tend not to. What tends actually to happen, because we're looking at the FTSE 350, that's the 350 largest plus the small caps, which are about 600 stocks, and we're looking for the best of the best of the best. It's very rare to have a concentration according to sector. Isn't that brilliant? We're not sector concentrated. The outcome becomes we get return spread across your portfolio, downside is managed, and we've got portfolio rebalancing for those who are really into this kind of stuff, because every 12 months we click the filter again and we buy the next 12 months worth of holdings. And how do we do that? Well, it's as easy as 1, 2, 3. We just click on the Alpesh Patel value growth filter down there and the names come up. That's it. The names come up. Now what this screen is, because I want to now move on to something slightly related to this, which is the individual stock filters and how I do it, is I first click on the Alpesh table, 1. Then I rank according to the Alpesh value growth rating, which is based on the value growth income that I just told you. It just rates things from 1 to 10. It never goes to 10, actually, so 1 to 9. 9 is the highest. 9 out of 10 is going to be the best and highest in terms of value growth income. And how did I get that score? It's a mathematical algorithm which weighs valuation, growth, and income criteria that I've mentioned through donkeys of research. You've seen all the books I've written in the Financial Times columns and the competitions won and the performances that I had, and then scores it out of 9 so we can easily view it. And then 3, I click on this, the momentum radar, my own momentum radar, which allows me then for each one of these to see a chart. And then when I look at the chart, I do 1, 2, 3. What do I do? Oh, by the way, somebody's asked me in which month do you do the stock selection. Any month you want. Doesn't matter, you're holding them for 12 months. You can do them any day of the year. You're holding them for 12 months from that time frame because all the data in the market changes every day. You're holding it for 12 months. The best stocks in 6 months to hold for 12 months from 6 months from now are not going to be the same as the ones to hold today for 12 months from now. So in a way, it doesn't matter which month. They're always going to be the filter. And the way you get that filter is you click on value growth, the Alpesh Patel value growth. Okay, so then once I've clicked on momentum, once I've ranked the various stocks, so that's 1, momentum. 2, I then want to look at the monthly chart. Yeah, and then 3, I want to look at this chart. And what I ideally want to see is the MACD rising, preferably from below this 0 line, so there's more momentum longer term. And I want to see a trend in place, preferably for several months. So in the case of Centrica, what I found is we've got a stock with a value growth rating of 8. We've got a trend in place. We've got momentum rising. Now remember, this is not where I'm using the value growth filter, where I've come up with my 14 to 15 stocks on that. This is where I'm using the Alpesh table to come up with value growth rating. Because remember, all stocks, every single stock on the Alpesh Patel Special Edition has in this corner a value growth rating as well. So for those people who only want what I think are the top 15 odd stocks, they've got the value growth item here. But for those who want their own stocks and say, Alpesh, what's your view, for instance, on Centrica? They can type in Centrica and they can see it's got a value growth rating of 8. That means I think it's one of the best ones out there, 8 out of 10, based on valuation, growth, and income. And because it's got a value growth rating of 8, and I then click on my momentum radar, and I can see, when I've clicked on M for month, that the MACD is rising. That bodes well. The trend is in place. I'm pleased because it's got a high value growth rating and the momentum is good. Now, if instead the momentum was going down and the value growth rating was below, say, 7, I'm going to think, nah, not interested, don't want this. So there's 2 methods I've talked about tonight for picking stocks. One is the value growth filter, which gives you the best 14. The other one is your own method, where you go onto my table, click on Alpesh Table 1, and then rank them by value growth rating for all the stocks which are out there for whichever criteria you're looking at. And then number 3, click on the chart, the momentum chart, to see a chart and see if the trend and the momentum has been in place. Yeah? And then you've got 2 methods. One, which just gives you everything on a plate, which is the value growth filter and the names. And I've explained why value growth income is such a clever way of picking stocks and the performances that we've had. And also on the ShareScope website, you'll see ShareScope have independently evaluated the performance year after year after year on them. And by the way, I'm aiming to get at least a 20% return on value growth income portfolios of 14 to 15 stocks. And 20% return for picking 12 stocks or 14 stocks in 5 minutes and then placing the order and forgetting about it for 12 months is not bad return on time at all. But the other way, as well as hitting that, is you put the stock name in, or you sort the stock using the Alpesh table, and then you evaluate it based on the value growth rating and looking at this. That's a bit more work for you, but gives you a bit more control. Whereas just hitting the filter button gives you the list of stocks and their name. So what questions do we have then about all of that? What we've got there is at a click of a button, you've got 2 methods which scan through every single stock and give you the names on a proven track record on which are the best. Now, do you pick, I've got some questions coming in now, do you pick your portfolio period to save having to sell them all at the same time? No, there's no problem selling them all at the same time. I have no problem selling all 12 or 14 at the end of the year. Why would I care? Because remember, I'm holding it for 12 months. So a day here or there is not a problem, or a little move here or there is not a problem. Any more questions on how this software has basically incorporated the best know-how on value growth and income selection, has taken all the data from ShareScope, this is where you can see it's called the special edition, and then put it into filters and tables and radars which allow you to evaluate the stock names, either your own. News does not come into it. No, news doesn't come into it, because I'll tell you why news doesn't come into it. News is incorporated in the fundamental data of price earnings, of sales, and of the technical analysis. Do you look at the daily or weekly chart to choose your entry point? No, I just pick them. The only time I look at the monthly chart is when I'm not looking the filter, but I'm actually just looking at this table. Then I'll look at the monthly chart to get an idea. What is the sell trigger? 12 months. 12 months are over. That's the sell trigger. Why did I pick 12 months? Because if you pick too short a period, then valuation doesn't fit into the stocks. If you pick too long a period, then new data's come in. So we found that 12 months actually is a pretty clever way of doing it. Does the filter work on US stocks? Yes, it does, but there the scoring is over a different number, because the data that ShareScope has is different for US stocks, but the same principles basically apply. How do you make your own personal list? Very simple, Brian. You click on value growth and you'll get a list of equities, and then you just decide, do I want the FTSE 350 plus small caps, or what do I want? And I just pick them out of that list, and there should normally be about 14 to 15 names in there. Now imagine there are only 3 or 4. Then what I'll do is buy those 3 or 4 and then keep checking until I've got 14 over a number of days. It might take a week, might take a month, and that's fine. Are all stop losses set to 25% and have no relation to ATR? That's right. All stop losses on this, because remember, the idea with this is to be really simple, save all your time. Which is, if it drops 25%, my point is, if it has to drop 25%, there is something wrong with the market. Forget ATR, there is something wrong with the market. What about stochastic? Not relevant. Stochastic is not relevant because what we're looking at is value, growth, income filters over a 12-month period. The only time you would look at momentum is if when you're evaluating your own stocks using this method, using the Alpesh Value Growth rating, the stock ratings, which is different to clicking the value growth filter, which gives you the best of the best. This is where you just rank all the stocks and it evaluates and scores them. Then you will look at the chart here by clicking momentum, and you will look at, say, the indicators and say, oh, okay, I'm going to get in because it's got good momentum. MACD is rising, probably below 0, but I don't look at stochastic because stochastic's too slow a time frame. Can you explain why it's not relevant whether the stock has been in the filter for 1 day or 12 months? If it's been there for 12 months, surely there is less upside. No. Anything which is in the filter is good for the next 12 months. It might have been there for the last 12 months, but that doesn't mean that it's not good for the next 12 months. The filter is saying if it's in it today, then it's good for the next 12 months. So whatever comes up in the filter is good for the next 12 months. Does it have to be January? No, it doesn't have to be January to December. It can be any 12-month period. Because remember, ShareScope updates its data daily. So anytime you're looking at it, it's going to be up to date for the next 12 months because things change month on month. And just because something was good from January to December doesn't mean it's good from February to February. What if MACD is very high, although it's still rising? Do you wait for a pullback? No, I don't wait for a pullback. But what I do there is I might, if all other things are equal, go for the one with the MACD. Do you exit automatically at 25% stop? Yes. Any stock which has dropped 25%, you exit because clearly something is not working for that stock. That's fine. Are the stocks trailing at 25%? No. They're fixed at 25% from entry. As May, June is typically poorer than the rest, would a 14 stock accumulation in May not have zero effect on downside? Terry, it's a valid point, but we don't look at it that way because we're still capturing 12 months. At any given time, we're still capturing 12 months. So whether I start in May, I'm still capturing 12 months, or whether I start in January, I'm still capturing 12 months. Now, you tweak it that way, tweak it this way. You're absolutely right. We can tweak things in a million ways. But our point with this portfolio, the reason I created this, was so people could buy, hold, and forget. They could get it done and get good results. If we start tweaking all the time, then we might as well just be actively in front of the screen all the time as well. And that's, again, then we're neglecting our return on time. So that was the reason there. Any other questions? Any other questions? Do you replace the stopped out stocks? No, brilliant question, Depinder. I don't replace the stopped out ones. And the reason for that is, I could have done, and there's nothing to stop you from doing that. It's just that because it's a 12-month holding and I want to keep it very low on time consumption, I felt, no, I don't want to keep on reinvest. I'll just run the filter after the end of 12 months. If 3 stocks are stopped out, do you replace them with 3 at that time, or do you wait for 12 months? Bob, you wait for 12 months. Does this technique apply to investment trusts as well as individual companies? No, this is for companies, because companies have different financial ratios to investment trusts. So this is purely for individual stocks. And it's to basically make you into a fund manager. By the way, we use this in our asset management to launch new products. So it's institutional grade, I can tell you. What about the overall rating? Well, the overall rating will tend to be 9 anyway for these, but it might be 9, 8, or even 7. I'm happy with that. Because what will happen is there is a relationship between the overall rating, the value growth rating, and the value growth filter, in that you'd expect them pretty much to be the same, but they're not identical. So I'm expecting them still to be the best of the best of the best. Any other questions? So like I say, this is one of the reasons why we have this bolt-on with the Alpesh Patel Special Edition. One of the things that I do for all the people who subscribe is they've got a monthly newsletter which not only explains all of this, but actually gives them my market view. I think it's about 30 to 40 pages long. My market view on individual stocks I like. So it goes through all of this, educates you every single month, gives you the best analysis out there from all the various sources like Bloomberg, Coutts, Goldman Sachs. I analyze and read those into the newsletter. So all Alpesh Patel Special Edition newsletter subscribers get that. And some people say that's actually worth the subscription alone, just the newsletter, because what you're getting through that is an analysis of all the individual equities, the ones that I like, and the education part every single month, and of course lots of webinars exclusively for the Alpesh Patel Special Edition users. So again, the idea is over 12 months you've got all of that as well as APS, as Alpesh Patel Special Edition users, having the additional bolt-on. So I hope you'll join me in that and become a newsletter subscriber as well. Is there any literature on how your value growth rating is derived? Yeah, if you look in the help center on ShareScope, there's a whole manual on the Alpesh Patel Special Edition, how I interpret everything that I've described to you tonight in the webinar, but also the value growth criteria and why I came across them, why price earnings ratios between certain levels, PE ratios, PEG ratios, revenue growth, return on capital employed, and how to weight those. Because it's important to know what's the significance of each one. And when you look at the academic literature over the last 100 years, you get an idea of which weightings are important for accuracy. If you get a large return after a few months, do you take profits or let it run for the full 12 months? Great question, David. If you think it's a bumper return and you think there's no way this can continue, you could exit. On the whole, I don't do that. I just hold it for the 12 months. It's buy, hold, and forget. Is this webinar recorded? Yes, it is. And what I'm going to do is make sure that they have it by tomorrow afternoon on the ShareScope website. And every one of you gets an email from ShareScope telling you of the recording. Can you give us the link to the 3 webinars, please? This evening, the sound faded in and out. I'll make sure that ShareScope upload the last webinar I did and this one. I've got one tomorrow, which you should all have received an invitation to, that you can sign up like you did for this one. But ShareScope can do that as well. And it'll be on their website, and they email you all. And I'm making a note, email everyone the recording link and that you can view it as well. Why is this an annual sub if your advocate is to fire once and forget for 12 months? Because value growth isn't all that Alpesh Patel Special Edition does. The Alpesh Patel Special Edition, as well as having the monthly newsletters, is good for short-term traders, which is what I discussed in the first webinar I did last week, which is recorded and should be on the ShareScope website. So it's good for spread bettors. And that's a separate issue. That's how do we use momentum for short-term trading. And that was in that webinar, as well as on the help that's on the software, as well as in my monthly newsletter. I pick the short-term picks and how do I use the momentum radar, how do I use the Alpesh table to come to short-term picks as well. What do you do if the markets start tanking? Well, you've got an exit, 25%. Now, the question then is, does that mean that all your stocks, Alpesh, dropped 25% in 2007 and therefore you lost 25% on your portfolio? No. That's what I love about this, because believe it or not, not every stock dropped 25%. Not only that, we had embedded profits. No, make no mistake, we were down, but we weren't down as much as the market. What do you do if the markets start tanking? So that answers that. Any further questions this evening? Otherwise, I will draw it to a close. I will make a saving of this webinar. Please look on the software that you already have in your trial, because that will, and the newsletter on the help pages, because that will give you the manual for the special edition, which also shows you the short-term trading and how to use every aspect of it for your short-term wins. And remember, this is the software that you use to get those FT wins, competition wins, write the books, appear on TV. It allowed me to set up on the asset management company that I have a methodology of picking these stocks. And I want you guys to do it without paying fund management fees, 2% per annum, stock management fees, but also understand the philosophy that I've given you behind value growth income and why you can be better. Thanks. Jenny, I'm so sorry about the sound this evening. All I can imagine is the internet is being heavily loaded this evening for some reason. But yes, the recording will have perfect sound. And the reason for that is it's being recorded on my computer, not via the internet, if that makes sense. So thank you all for this evening. And thank you, of course, all for your feedback. Thank you kindly. And apologies for my cough as well.